Welcome to Real Estate Investing for Professional Men and Women, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hi, everyone. This is Gary Wilson, and welcome to this week's Real Estate Investing for Professional Men and Women podcast for you. If you're an engineer, pilot, teacher, fireman, dentist, orthodontist, the list goes on and on. Almost always professionals, a lot of times business owners. So this is the place where we go to interact, connect, and talk about investing. We invest ethically, honorably in the areas we do invest in, and we make it win-win for everybody. The community wins, we win, of course, the tenants win. And if you haven't subscribed yet, please do so. This is on probably 30 some odd different channels now, and downloaded in 30 different countries also. So also, if you want to be part of the community, go to myinvestmentservices.com, click on the members area, go in there and you'll see silver level. Some of you are already members, some of you you just to check it out. So click on the one on the right to check it out. But the reason we do this is we're thousands of us strong, several thousand actually, US and Canada and the Bahamas, actively producing. And also more importantly, we've got what we call investor agents out there. These are agents we've trained to work with us. They're certified. It's a certification agent. So make sure you're dealing with fourplexes and flips and things like that. You make sure the agent you're working with is a certified investor agent. They can only get the designation in one place, and that's through us. So join the community and have the right people serving it. So in any case, without further ado, let's go ahead and jump into today's session. We got a great guest, Andrew Cushman. Andrew Cushman and I have been members of the same mastermind for probably 5 years. You've probably been a little more than 5 years, actually. So great community. Most of us do invest in real estate, not everybody, but everybody's different walks of life. I mean, different backgrounds, different industries, and more likely business owners. So Andrew, welcome aboard, brother. Glad to have you on this, and appreciate you taking your time,
Yeah, glad to be here, Gary. Appreciate the invite.
Excellent. Hey, if you wouldn't mind, just paint a picture for people, who you are, like where you came from, how you got started. I know like you and I both have the same background as far as engineering goes. But kind of paint a picture for you, because I want them to see that we all came from different areas, and anybody can do this,
I took the traditional path into real estate and went and got a chemical engineering degree from Texas A&M, and that was actually just a placeholder. I always knew I wanted to do my own business. I just didn't know what. So I went and figured a chemical engineering degree. I could always have a job and a decent income until I figured out what I really wanted to do. So I worked as an engineer for 7.5 years. Tried a bunch of little businesses, met the perfect wife during that time frame. She joined the cause, and we eventually, in 2007, discovered house flipping here in Southern California. And so we started trying to do that, and that involves cold calling homeowners. And which as a chemical engineer, cold calling skills wasn't exactly my forte. So it took me 6 months and 4,576 phone calls to get our first deal. But we eventually did, and when we resold it, we made basically as much as I did at my job all year. And said, all right, you know what? Don't really anticipate something being better than this. We're still fairly young, don't have kids yet. It's either now or never. So I went in, quit my job, went into flipping full time. My wife joined me 2 years later, did the same thing. And then in 2011, we've had in 2009, we had a really good year. And then 2010, we're like, all right, this has been great. It's not going to last forever. But, what's the next big thing? You're like, well, we just came out of a recession. No one can buy a house right now. But we're going to have a growing economy. So, all right, people can't buy, jobs are going to be created. All right, so apartments are probably going to do pretty well here in the future because, again, no one's going to be buying houses for the next 7 years. Everyone got foreclosed on and no one wants to write a loan. So we went and found a mentor to learn the apartment business. And in 2011, we did our first deal. It was 92 units, mostly vacant on the complete other side of the country in Macon, Georgia. And that was quite the challenge, but it worked out well since then. And then we went full time into apartments. Since then, we've done a little over 1,800 units, and apartment syndication is our full time job.
Well, I'll tell you what, there was a lot in there, and the one of the main messages for me is just you really just got to get in the game swinging the bat. You got to take action. I mean, I admire you for for taking such a giant leap forward in the beginning, but also seeking mentorship, because I didn't get where I am by myself either. I definitely a lot of help along the way, and it pays. And I didn't even have one of the big, famous gurus you hear see on TV. This guy was just somebody I met through the apartment association. He was getting ready to retire. He was in his 70s. This old German dude, Gerhard Flugfelder, and paid him $1,000 a month.
That's a great name.
It is Gerhard Flugfelder, and he's since passed away. God bless him. But he tell you what, took me under his wings, and it was well worth that money. I made literally multi millions as a result of what I learned from him. And applied. You have to do the work, but you apply what the mentor shows you. So let's do this. I want to kind of talk about the property in Macon. So 92 units right out of the gate, man. And I'm familiar with Macon. I've actually taught classes there before.
Oh, wow.
Yeah, a little bit southeast of Atlanta. And but tell us a little bit about this. I know you worked your butt off. I mean, call after call after call after call to get these deals. But what was the nature of how did you structure that transaction? I want people to kind of see that, you probably didn't walk in there with millions of dollars. You probably walked in with the vision, and you had to come up with the goal and the plan to carry out the vision. So if you wouldn't mind kind of paint that picture, that would help a lot,
Yeah, and keep in mind too, this was in 2011, so pricing was a whole lot different back then than it is now. So that property, we got it through a broker relationship. We had looked at some other deals that this broker had, and then he had this one, and he brought it to us, and we looked at it. And actually, my mentor was out in that area, so he drove it for us and reported back, and was like, "Yeah, I think you guys can do this deal." And it was, I said, 92 units, $699,000, but it needed almost as much in renovation.
Mm-hmm.
So the total that we needed was 1.2 million. And candidly, we underestimated, and this, and this was back in the day where financing was extremely difficult, right?
Mm-hmm.
No one was lending on anything. Plus, this was a 75% vacant property. It was highly distressed, so no one's going to loan on it. So we intended to go in all cash and then refinance it later, and that did work. That's what we ended up doing.
Mm-hmm.
But being our first syndication, we underestimated how hard it was to raise $1.2 million on your first one. And again, back in, this is still the recession-ish time when people are scared of real estate and anything related to it.
Right.
So we underestimated how hard it was to raise that. But after 6 months of just, exploring every relationship we knew, every opportunity we knew, we got $1 million, and then we got the seller to carry a note for the remaining 200,000. So we were finally able to get it done. And then we eventually did, get it fully repositioned. We got it up to, when we bought it, they were collecting $8,000 a month. When we sold it, we were collecting $42,000 a month, which is still low, but it's a lower income area. Right. And, we were able to, we got a refinance, paid everyone back, and then kept it a few more years and then sold it. So it worked out, but it was an agonizing 6 months, I'll tell you.
Wow. Yeah, I bet that was probably stressful too. So you had 92 units to remodel. So you probably had the interior, the units themselves, you probably had common areas, and you had, of course, the outside, the shell, basically, whether it was brick or siding, whatever, roofing and all that. So what were some of the projects that had to occur? Did you have to redo boilers, HVAC, plumbing, anything like that? What were some of the remodeling that you did on the property to improve the value?
There was a lot, and this is, that first property, while it was successful, that affected a lot of our current procedures and screening and what we will not do, right? So when you buy a 60s and 70s construction property that's especially been neglected for a while, it's like peeling back the layers on a rotten onion, right? You think I'm gonna pull this rotten layer off. Well, great. There's another rotten layer underneath it. So we had to do everything. We had to do a lot of HVAC. Fortunately, it was central air on most units, but also some had window. We had to do all the flooring, painting inside and out. Roofs were actually okay, except for I think we replaced 3 of those. We replaced most of the windows, needed some electrical work. I mean, the parking lot needed to be redone. There were some plumbing issues. All appliances had to be redone. Most countertops, all flooring had to be redone. It was pretty extensive. And so what we actually did to do that is we hired a construction manager who used to be a GC, and he went and lived there and to run the renovation for us. So.
Wow. Well, I tell you what, that's some big jobs. I mean, I know one of my first big property after owning a bunch of smaller ones was a 70-unit complex. And we replaced all the boilers, parking lot, some of the big, almost identical to what you just described. But so when you did that, I'm just curious. So for everybody listening, it's 75% vacant. Did you work on all 75 at the same time, or did you like roll through, do one building first, get it up and running, move to the next building? What was the staging? How did the logistics of it roll out?
Well, that's actually one of the few benefits of buying a property that's mostly vacant is you don't have to coordinate a whole lot because you can just go in and knock it out. So what we did is we picked the buildings that were actually, again, they're mostly vacant. So we started with the ones that were closest to the office.
Mm-hmm.
Number one, that had some of the better landscaping and nicer looking part of the property, but also, one of the challenges you run into with a property that's that vacant is vandalism and theft. So we started with the buildings that were closest to the office because we would be watching. It'd be easier for us to watch those on a more consistent basis. And we try to just knock out a whole building, get it occupied. Because again, if you've got a building with 8 units empty and you're rehabbing it, and you got a building that only has 2 units empty, the odds of a problem with theft or vandalism are much higher in that building where that's all empty instead of where there's 6 neighbors. So we basically started near the office and then worked outward from there as we filled the units.
Okay. Now the actual buildings, was it clusters of like 4plexes or 8plexes or 10plexes, or what was how many buildings were there? I guess
I don't remember the exact number of buildings. It was 12 or 13. It was an interesting mix because it was built one phase 60s, one phase 70s. So there was a handful of buildings that had 8 units, and then there was there's a handful of 4plexes. And there might have even been a duplex in there, but it was kind of a mixed bag. But I think the predominant was 8. I want to say 8 units per building.
Okay, good. So it was all said and done. You got this beautiful complex, 92 units up and running. Obviously, you raised the rents. It's producing, going from 8,000 to 40,000. That's such a huge increase. So when it came to the value of the building, when did you said you did actually sell? Did you refinance it along the way and then later sell it, or how did you?
Yeah, we refinanced it, paid off the seller note, returned a bunch of investor equity, and then we held it. I want to say another 3 years or so, and so we bought it for $699, and the sales price was either 1.71 or 1.91. I don't recall. It was somewhere, but it was one of those two.
Yeah, that same thing. Ours we sold for like 1 point. We bought it all in. It was about 940,000. Sold it for like 1.78 or something. 1.78, like 1.782. And so we cleared a nice big chunk of change there too. And along the way, we didn't have that tremendous growth of rents. We went from 8,000 to 15,000 on the building. It sounds like these buildings are pretty similar. We were spread across over 2 acres, by the way, 2.1 acres. But in city units, there was a lot of property, lots of grass. I mean, it was just. But tell you what, that was. It sounds like in your case too, it's a good example of how real estate, I call it a very forgiving commodity. You can make some errors in real estate as long as they're not catastrophic and still actually come out ahead. You can correct things, physical things that are wrong with the building. You can evict tenants and be the new sheriff in town and get new tenants in and basically redo the management. So here's what we figured out. It's actually better to take on management issues than it is physical issues. It's because you can see it. I mean, it's like it's a procedure versus opening up a wall. Like you said, peeling back the layer of the onion. Sometimes, man, you could come up with all kinds of stuff when it comes to remodeling. But when it comes to management issues, once you get better at management and hiring the right managers, you can clean those up pretty quickly.
And it's definitely generally less capital intensive too. So then in that sense, your risk is lower. Yeah. If you're doing a management value play.
Yeah. Well, let's talk about, so great example, by the way, right out of the gate. And it just goes to show you, if you're listening to this, most people are thinking duplex, triplex, fourplex, but here comes Andrew Cushman knocking a 92 unit out of the park. So, I want to talk a little bit about geography. So that one was in Macon, Georgia. And me, Andrew, I'm constantly traveling and teaching in over 600 cities and towns. And I've been to places like, Lafayette, Indiana, Fort Wayne, Indiana, all these really small tier 3 towns, not tier 3 like level of quality of economy, but size. So like here I'm in Texas right now, Temple, Texas, Fredericksburg, Texas, great areas, not too far from San Antonio, Austin, but close enough you can drive there and have people who represent you drive there and get one thing. So how do you feel about those areas? Do you focus more on the larger metro areas, or how does geography play into your strategy?
Well, there's the wide scope and there's the narrow scope. So for the wide scope, we look for regions with good demographic trends, right? So you would say, in general, Texas is a region with great demographic trends. A lot of people move in there, a lot of jobs move in there. Same with Utah and Idaho. Another one, then the one that we choose to focus on is the Southeast U.S. So that's the northern half of Florida, Georgia, and the Carolinas. Is generally speaking, those are states where you have a lot of in-migration, people coming from the north and Northeast and the Midwest moving down there. You have a lot of jobs coming down there, and those are the two fundamental drivers for multifamily in particular is jobs and population growth. So as a region, we look at our choice is the Southeast because of those two things. Okay. Within the Southeast, we of course love Atlanta. Atlanta is kind of like the Dallas of the Southeast. However, like Dallas, it's also extremely competitive. Money's coming from all over the world to Atlanta. And now actually with the new rent control laws in New York, money's coming down from New York to Atlanta because it doesn't make sense much up there anymore. And so Atlanta is super competitive. So while we really like Atlanta and we do try to buy stuff in Atlanta, it's much harder to actually achieve that and still get the kind of returns and safe margins that we want to have, especially at this point in the cycle. So that is really our niche, is secondary and tertiary off the radar markets that aren't big enough to be on the radar of that big money, but have really good economic stories, right? So places that are, we own two properties in the city that almost no one, probably except for you, has heard of. Is called Grovetown, Georgia. Right, it's this little suburb of Augusta. Well, the population growth there is almost 100%, and it's projected to continue basically at that rate for the next several years. The population, the job growth there is incredibly strong. In fact, it's so strong that the city put a moratorium on everything because it's overwhelmed with their sewer system. Like there's so many more new people coming in that they put a 6-month hold on everything, right? Yeah. And then what we look for is like, especially at this point in the cycle, is okay, what's driving that growth? Is it something that's going to crash in a recession, right? Well, when you look at higher education, military, and medical, those three, in government, those four things generally aren't affected very negatively by a recession. They just kind of keep chugging along. And so that, so we like that. Now we don't want to, again, some people do and do well in this. For us, we don't want to go into a town that is just military, because if that base closes or there's a huge deployment, you could have an issue. But as a pillar of the economy, we do like military.
Yeah.
So we look for, small markets like that. We're in some Panhandle, Florida markets that, again, very small, no one's ever heard of. But if you look at the demographic trends, like for the last 10 years, you have 2, 3, 4% annual population growth. Right. They're not building anything new there. And so the rents are going up, the occupancy is crazy high. So those are our niche markets. Again, we love buying in Atlanta and the suburbs of Atlanta, but those little off the radar markets are where we can get some really outsized returns.
Yeah. Well, you hit the nail on the head there, and I agree. There's another little town you've probably been to, is Columbus, Georgia. It's southwest of Atlanta, college town.
We own stuff there.
Yep, exactly. Right on the Alabama border, and
Phoenix, Alabama, and Columbus, Georgia.
That's it. So so by the way, Augusta, there's Augusta, there's North Augusta too. I might be maybe another name for the town you mentioned, but that also has been a pretty good area for growth. So. Interesting. It's like two different towns, but it's the same area. So in any case, I appreciate you sharing that, because that's some vital logistics. And also, folks listening, medical, higher education, those two areas for me have been a big part of my success. And what I realized is interesting, in a recession, college enrollment actually kind of goes up sometimes. If you look at it statistically, it's crazy. So it's like the opposite of what you might think. And whenever you can be around a teaching hospital connected with a college university, now you've got the interns, the residents, nurses, graduate students. So, and the military folks also, turns out, like I'm a broker too, so I'm an investor, and we have a brokerage company. The military folks make great investors. They learn to use and reuse their VA eligibility. And they'll buy properties and they get transferred. They keep the one, but refinance it with a commercial or a conventional mortgage, then reuse the VA eligibility in the next place for getting stationed. Um, and a pretty disciplined group of people too. Great tenants. Always had a lot of success with them. But the bottom line is, compared to where we were in 2011, we're in definitely two different worlds. But how has timing affected your investing strategy, if at all? And what are your plans and goals? Because I know, like most people I talk to, and me personally, we keep on investing. We really don't care about what the economy. I mean, we care about the economy, but we'll have different strategies. So, what have you noticed as far as the evolution of your strategies when it comes to timing, like where we are in the market?
It's definitely changed. We have very strict screening procedures now. So anytime we get a property or a new deal that we're looking at, we're checking what's the median income there. Is it in a flood zone? What's the population growth? What do the schools look like? We check into the crime, the size of the market. There's a whole list of things that screen it, and then if it doesn't pass all of those things, we're automatically tossed, right? But let's say it does. Well, we're definitely being more selective about markets at this point in the cycle. Number one, whenever a recession does come, whether it's moderate, small, huge, whatever, generally the areas that suffer the most are the lower income areas, and especially those areas that don't have those job drivers that we just went over. So we are very careful to stay out of those areas. In fact, out of our, the 1,800 units we have sold off, I want to say between 700 and 800 units. And those were all properties that we felt were in markets that may not do as well in a recession. And so the stuff that we still hold are properties that we feel like will do fine in a recession. Like, so some of the stuff that's in the perimeter of Atlanta, maybe we won't get rent increases for a couple of years, but we don't need to. We're already so far and above, our pro forma and what we bought it at, that it'll just cruise right along. And even if we had to drop rents, we'd still be fine, right? We have huge margins. So when we're looking at buying, the number one thing, if it passes that screening procedure, is the first question. 5-7 years ago, the question was, how much can we make on this? The question now is, what's the potential downside on this? And then if the potential downside is acceptable, then we ask, okay, what's the potential upside? And if, if the recession doesn't materialize, or, I think Australia's gone, 28 years without a recession, right? So it doesn't have to happen, but, it probably will. So it's changed and it's eliminated some markets. Candidly, I won't buy in Macon right now, unless it's maybe the absolute best part of town. It's very flat population growth. Actually, they're losing population. There's some of the, so we're being more selective about markets. A little more selective about property age and type. We want to be in the middle. We don't want to be Class A, because people tend to move down from Class A in a recession. But then in Class C, when you have people that are barely making ends meet in good times, as soon as their hours get cut back a little bit, or they get a flat tire, something like that, they can't make rent, right? And they start having to dust. So vacancy and delinquency tends to increase in C properties. So we're kind of narrowing down to the B properties and in markets that we feel will do well, recession or not. So it really has affected. We've eliminated some properties, some markets, and gotten a lot more strict about where and what we buy.
Well, I appreciate it, because the fact is, you're still investing. You've evolved or modified your strategy relative to timing, but the bottom line is, you didn't let timing defeat you or derail you or keep you from investing. You just modify your strategy, which is the thing I want people to realize. Because I've had people come in and say, well, I'm just going to wait. I know it's going to be another recession. I'll wait till then. It never happens. People will say that, and it's just, you're just saying no. They're saying no to opportunity,
Yeah. I mean, I know someone who 5 years ago said, all right, I'm not buying anything more. It's too high. I'm going to wait it out. I'm like, man, that guy's missed on a lot in the last 5 years. I mean, what it boils down to is there's no such thing as a bad market, only a bad strategy. Right. You just have to change the strategies to adapt to the market.
Yeah. And you'll have different areas. There's another great area, Carolina's Wilmington, North Carolina. Obviously, there's on the ocean front, there's a lot of great beach towns, Top Sail and all of the beaches between Wilmington and Myrtle Beach, or that whole Sunset Beach, I forget the different ones, Holden Beach. But Wilmington itself is inland, just about a 20-minute drive. It's a college town. And, I've been there a lot of times, and you'll still see opportunities there. I mean, there's even in the town, beautiful, great town, except there's some storefronts that are still empty and all that. But it's a great opportunity. And people just bypass it because they think, well, it's a resort area. But Wilmington's really not a resort area,
Mm-mm.
The surrounding areas are resort areas. But Greenville, North Carolina, is a great hospital there. It's not the kind of area you probably would live in, but it's a strong rental market. Got a lot of people renting. They have some crime issues, but they've got a big hospital there, and so there's one of the key economic drivers. So the strategy, I guess what I'm getting at is that you might have a different strategy in, say, Wilmington, North Carolina, than when you have, say, back in Macon, Georgia, or over in like Destin, way off the far left of the panhandle of Florida. And I was 2 years ago, 1 year, 2 years ago, I was driving across the panhandle and checking things out, teaching classes. And there were people around properties in Pensacola where you could still get oceanfront one-bedroom condos for like $65,000 right on the water. I mean, in Gulfront, amazing. So let me ask you this: is there so going forward, is the model to still look for the like how many numbers are you looking? Well, how many units per purchase is there? What's the range? Like 1 to 300, 2 to 400, or is there a range?
Yeah, for us, we're generally looking at stuff that's between 80 and 230 units per asset. The reasons for that is we find that's where we get the best efficiency as far as personnel and expenses and just smoothness of operating. 80 gets a little bit tough because it's actually getting on the small side for, we want to have at least one full-time management, one full-time maintenance. 80s gets a little bit tough, but the right property in the right area still works fine. Kind of the sweet spots we found are just is about like 120 units and about 220 units. Anything those sizes works really, really well. Yeah. But anything between 80 and 230, we like. We've owned as big as 350. And there's guys that do specialize in that kind of stuff and do really well with it. Yeah. For us, we kind of said, we actually don't prefer stuff that big, especially this late in the cycle, because if we're doing value add, right, meaning we're renovating and raising rents, it takes a while to get 350 units done and cycled through.
Oh yeah,
and things could change before you get all the way through that with that size of property, and then it's just kind of a little bit slower of a turnaround. So,
right.
Would we never buy another 350 unit property? No, I mean the right market, the right deal, we would certainly look at. But for us, the real sweet spot seems to be about 80 to 230, 240.
Was that the one? I think we're looking at a couple years ago. It was in Atlanta, I think, 350 units. Was that one, or is it a different one?
No, that one was in Dallas.
Okay. Yeah, I think the one in Atlanta was like it had been shopped around a lot, and it had some big issues. I don't know if you recall it or not. I think I showed it to 3 other people that already showed it to you.
Oh yeah. That I think it eventually found a buyer, but yeah, that property was something I would certainly stay away from.
Yeah. Okay. Hey, I tell you, we're getting close on time here, but as far as so when you get, let's say you get 120, 200 unit property, and you're in Southeast, as far as the team, like how do you select somebody to manage the remodeling project if there is any? How do you select somebody to do the management, the property management itself? Is there a methodology there you can share, or what any particular pattern you've noticed when you're looking at people and interviewing?
So for property management, we use third-party property management, and now at this point, we've consolidated the whole portfolio with one property management company that their focus they just do the Southeast. So their territory is actually the same as our territory. Mm-hmm. So that's where they're based in Atlanta, and that's where their expertise is. But how we found them is when we bought that first, when we first started buying in Georgia, we would just ask the brokers and say, "Hey, who are the top 2-3 people that you would hire to manage a property like this?" Right? And we kept asking that question. We built the list, and then of course the same few names kind of filter to the top over and over again. So we said, "All right, here's our top 5." Then we do internet research on them, and that knocks out a couple. And then we had it down to 3, where I did phone interviews, and then I think it was 2 of them I met with person, the owners of the company. I flew out to Atlanta and actually, had dinner with them. And then we ended up hiring the one that we felt best. And that process worked really well because that's still the company that we use, 8 years later down the road. So property management, that's they handle all of that. As far as renovation goes, it depends on the scope of the deal and where it is, right? So we're doing a major renovation in the Florida Panhandle. We have a large general contractor that's down there, and they've got like 30 guys on site, and they're living on site, and they're just cranking it out, right?
Mm-hmm.
Another property in South Georgia, 150 units. We did a little bit differently. We actually hired our own rehab coordinator, who same thing. She, there every day. She brings in the subs, coordinates the subs, kind of makes sure everything gets handled, and does that. And then on maybe a little bit less complicated projects, our management company has several really good dedicated rehab specialists. And they will come in and help, get bids for redoing the parking lot or getting the roofs done, or whatever needs to be done. So we have different ways of managing it depending on the scope of the project.
Okay. Well, I appreciate that. By the way, Andrew, you shared a lot of really good intel today. So I think you helped a lot of people. Is there anything, if somebody, I know you don't have like a training program or stuff like that, but is there anything you can offer to people, a way for them to reach out to you, even if that's what it is? Because if you're looking for people to participate, a lot of the folks that I'm working with and people listening to the podcast are often well capitalized. They get great incomes because they have businesses. But is there a way for them to at least be interviewed, perhaps, or selected for a potential future investment?
Yeah, I mean, you can always connect on Bigger Pockets and LinkedIn, but if we actually want to have connect for real and have a real conversation, then my company is Vantage Point Acquisitions, and the website is basically an abbreviation of that. So just V like Vantage, P like Point, ACQ, short for acquisitions.com. So just VPACQ.com. There's a contact us button on there, I think in the upper right. If you fill that out briefly, it comes right to my inbox, and I'll get back to you as soon as I can.
Okay. Well, for everybody listening, this is one podcast, guess where I can personally vouch for it. I know the group that we're in, there's a mastermind group called GoBundance, an awesome mastermind group. Almost all of us invest in real estate, and a lot of the guys, it's just the continual, A+ rating that they continue to go to Andrew for helping them deploy some of their precious assets. So I don't. I've done a lot of podcasts. I've never done that before, by the way. So this is but he's a good guy, smart, and does a really good job. So Andrew, I think I speak for a lot of people when I say thank you again from the bottom of my heart for sharing not just your time, but your knowledge with everybody. So thanks for doing that. And everybody listening, stay tuned. We'll have another one next week. In the meantime, God bless you and your families. And if you have not subscribed, please go ahead and do so if you'd like to. My Real Estate Investing for Professional Men and Women. And go to myinvestorservices.com, click on members area, and check out the silver level members. I'm one of the members too. We do a lot of networking there, joint ventures, all kinds of neat stuff. So plus all those specialized investor agents are out there ready to help you, and guys like Andrew too. So guys, take care. God bless you. We'll see you next week.
Thanks for listening to this episode of Real Estate Investing for Professional Men and Women. Be sure to go to myinvestmentservices.com to join our community and start building wealth today.